Let's talk about the yield curve, because you might have heard this term on this channel many times, okay? But now you're hearing and seeing this is being discussed by the mainstream financial media as well as the financial influencers. Why? Because the yield curve is one of the best indicator to predict recession, okay? And 9 out of 10 times in the history, whenever we have seen the yield curve gets inverted, and then when it gets uninverted, this is always followed by a recession. Okay, so this time is not different, guys. Okay, no matter what the mainstream financial media is telling you, this time is different. It is not. Okay, in order to understand the yield curve, you need to understand the bond market. Okay, what is bond market? So bond market is basically the biggest market, financial market in the world. Okay, it's much bigger than the equity markets, and every country has its own bond market. Canada has its own, Japan has its own, Europe has its own, Australia has its own, and then US has its own. Okay, the US treasury market, the US bonds we call them, they are the bedrock of the financial system, the global monetary system. Okay, why? Because the US treasury is actually used as a form of collateral to generate more funding, more capital in the global monetary system. Okay, and oftentimes the US treasury is used multiple times, up to 10 times, in order to basically generate capital in the global economy. So when we look at the US treasuries, they have many options. You know, you have a longer term bond, let's say 10 years, 20 years, and 30 years, and you may have a shorter term T-bill, like 6 months, okay, 1 year. And depending on the term, in a healthier economy, a shorter term bond will yield lower as compared to a longer term treasury bond, let's say 30 years, because when you buy a bond, you're lending money to the government. Okay, and if you are carrying a 30 years treasury bond, which means you're carrying a lot more risk in terms of inflation, recession, economic downturn, what could happen in the next 30 years. So you should be compensated with a much higher yield, as opposed to if you lend the money to the government for a 6 months period. Okay, the 6 months is much shorter time, you're carrying less risk, so the yield you're going to get on that T-bill supposed to be lower as opposed to when you buy a 30-year treasury bond. Okay, so in a healthier economy, when you draw the curve of the yield, the curve will look like this. Okay, so short-term bond will yield lower compared to a longer-term bond, which will yield higher. In a normal economy, that's how the curve should look like. But in a weaker economy, where you have a lot of economic distortions from central banks and the government, this curve gets inverted. Okay, which is what we are seeing right now, that the short-term bond is yield higher, but the longer-term bond is yielding lower. So if you are a lender, you're lending money to a person who's getting this loan for 30 years. Are you going to ask for higher return for this compared to if you lend the money to a person for 6 months or not? Common sense, right? You will be asking more return for a longer term commitment compared to a short term commitment, because you're carrying a lot of risk. That's typically how it should be in a bond market as well. But when you have a weaker economy, then this curve gets inverted. Okay, so right now the curve, the yield curve, which is the difference of yield between a 2-year treasury and a 10-year treasury, is inverted, and it is now coming back up and getting uninverted. So if you look at this chart, you can see the gray lines are showing the recession, and when the yield curve crosses this black line, which means it is getting inverted, and when it bounces back and cross this black line upwards, that means it is getting uninverted. And when that happens, history tells us always followed by a recession. Okay, so it is about to cross that black line. By the way, it's coming closer. This uninversion of the yield curve can happen in two ways. First one is called bear steepener, and the other one is called bull steepener. In a bear steepener case, what happens is the long-term bond, the yield on the long-term bond gets higher and higher and higher. It becomes higher than the short-term yield. Why does it happen? Because a lot of investors are actually dumping the long-term bond because they are not seeing the return in the longer term, which is why it is bearish for the long-term bond. Okay, so that capital is going into either a short-term treasury or in the equity markets. So it is actually good sign for economy because the capital is moving into other parts of the economy, okay, versus the bond market. So when the bear steepener happens, it is typically a good thing. But a bull steepener in which the long-term treasury stays the same, but the short-term treasury yields start crashing down, okay. Why that happens is because the investors who carry those bonds, they're seeing much bigger risk long term. That's why they're buying short-term bonds, and when they buy the short-term bonds, it actually suppresses the yield, because when the yield of the bond and the price are inversely correlated, when you're buying a lot of bonds, it actually brings the yield down, okay. So right now what we're seeing is a bull steepener. So you're seeing the longer term treasuries kind of staying the same, but the short term treasury bonds are yielding lower. The yield on those bonds are crashing down, okay. And when it crashes further down, it goes below the yield of a long term bond, let's say 10-year treasury. This is when we see a bull steepener coming ahead, and it is bullish for short term bonds because the investors who carry the bonds are seeing much bigger risk, further down the road, versus purchasing just a 2-year treasury, for example, because that's a safe haven for them, okay. They're not parking their money in equity markets or in other real economy because they're seeing much bigger risk to lose their capital versus just park their money in a short-term treasury bond. So right now we're seeing this bull steepener case, which is bad for economy, okay. If that's going to continue and the curve gets uninverted, this is when the stuff hits the fan, and this is when you should be paying attention to it, because if that happens, everything will go down. Bitcoin, equity markets, gold, pretty much everything will go down. So you have to make sure that you protect yourself from this kind of economic downturn. Otherwise, a lot of people have been burned in previous recession, and this is also posing you an opportunity to take advantage of it, okay. Let's talk about that in the next video, how you can take advantage of a economic downturn. But if you like this video, give me a thumbs up, subscribe, and ask me any questions. If you need any financial advice, I have a series of financial advisors on my list. I can connect you with them. They can give you the best financial advice based upon your scenario. So let me know if you need any help. Reach out to me on my email address and check the link in the description because there's some free stuff available for you. Take advantage of it, and I'll see you in my next video. Take care. If you are an investor in the US, in Canada, or in Europe, and you are considering investing into Dubai real estate market, this video is for you, because we have a platform called Stake, which allows you to invest into the residential real estate market and start earning rental income right away without going through a lengthy documentation process or coming up with a heavy down payment. Stake is built upon the concept of crowdfunding. So it is democratizing the entire investment strategy and allows you to own a single unit of the entire investment portfolio. So you don't have to own the entire property, right? You can be part of the pool that can actually own a piece of property, a piece of real estate. So that allows you to start with as low as 2,000 dirhams, and you can slowly ramp up. So as you start investing into it, you can not only own a bit of real estate, but you also get a portion of the rental income on monthly basis. So it's a passive investment strategy, diversifying your portfolio from traditional North American or European markets into Dubai, which is hustling and bustling and growing very fast, and allows you to build your wealth over time. So don't delay. There is a link down there in the description. If you click on this, it will give you free 200 dirhams in your account right away to start with, and you can thank me later.